Hello, and welcome to Fidelity Connects. I'm Lauren Gardy. At the start of the year, Fidelity Canada launched 3 new products built on Fidelity's robust, quantitative, and fundamental research. These new products, and many others, including Fidelity's factor ETFs, are managed by Fidelity's quantitative research and investments team, which includes more than 200 dedicated quant developers and technologists. In today's digital age, where data is playing an increasingly important role in every facet of life, quantitative investing is expected to grow in the marketplace in the years and decades to come. I am pleased to be joined today by Neil Constable, Fidelity Head of Quantitative Research and Investments, to further unpack the quantitative research and investment division and how it fits within the broader Fidelity ecosystem, and share how these new data-driven solutions may benefit you and your clients. Welcome, Neil. It's great to see you again.
Hi, Lauren. Thanks for having me.
Of course. So for those of us who might be joining us for the first time today, Neil, let's first lay the groundwork and describe the group you run at Fidelity, QRI, the Quantitative Research and Investments team.
The organization, as I think you alluded to, is relatively new. It's about 5 years old, and it comprises approximately 200 quantitative researchers, portfolio managers, in addition to another 200 or so, 250 probably, quantitative developers, software engineers, data scientists, and so on. And it really it's grown up pretty quickly, and it touches a lot of the different elements of Fidelity on both the traditional active fundamental investing side in equity and fixed income and multi-asset class, but it's also enabled us to really dial in and launch new products in systematic equity, systematic fixed income, and increasingly, actually, as you have on your screen now, a wide array of factor ETFs designed to capture particular exposures in the market. And the way I like to describe it, so to keep it simple, is one of the things that QRI enables for Fidelity is it lets us listen to our customers, and they sort of, you get to decide for us or tell us what's the size and the shape of the box, as it were, that you'd like to consume Fidelity's best investment thinking in. So that can come in the form of various preferences for yield in a high fixed income portfolio, like we'll talk about later. It could come in the form of getting the best of our fundamental thinking and fundamental analysts and portfolio managers thinking into a portfolio. It could also be dedicated exposures to particular factors or themes. And our job in the quant group is to learn and to sort of design that box for you, and then stuff as much good stuff into the box as possibly fits. And it really enables us to be more responsive to different customer needs, provide solutions in ways that would be difficult to do or almost impossible without a quant team. And so that's why we're here to talk about those products today. But I think it's also important to understand that there's a lot of benefit this group has in working directly with Fidelity's core portfolio managers in all the asset classes.
Mm-hmm. So. That's fantastic. Thanks, Neil. A lot of advisors, as you mentioned, do think about Fidelity as a fundamental or active shop. Could you talk a little bit more about how your team works to support our active managers?
Yeah. So, if the world has gotten, and you talked about this a moment ago in the introduction, the world has gotten to be a much more, I guess, complex place. But what I mean by that is there's every day there's more and more technology available to do more and more things, and part of that is, of course, all the fad right now, or the trend for generative AI and things like that. But it's beyond that. It's the cloud computing and everything that's enabled. It's the Internet of Things. People don't talk about that too much anymore, but everything is wired up in one way, shape, or form to the Internet, and spits off data. And much of this data from every facet of economic activity is available to be harvested and collected, and it's usable for investment purposes. And so, whereas it used to be maybe in a traditional fundamental process where you're trying to understand individual companies, their business models, their growth prospects, and all that, you're searching through like a needle for a needle in a haystack, right? All this data that was available then, 25 years ago, you had to find that needle or two, maybe two needles, and connect the dots, and aha, this is the company that's going to grow. Today, it's much more like searching through maybe 10,000 haystacks looking for a needle, and you never know which haystack the needle is going to be in. And so it requires an entirely different toolkit because much of this data comes not from talking to companies, which is still very, very important, by the way. But a lot of it comes from cell phone towers or logistics networks for supply chains. And the more of that we can collect and get into the hands of our investment professionals, the more complete picture they have of the health of the company, its growth prospects, how its competitors are doing, how it's faring in the macroeconomic environment or policy environment that we all know is rapidly changing today. And the way you get more conviction in your investment ideas or find indeed new ideas that are going to benefit from the current state of the world is to have as much data as possible. And so, and like I said, because it comes from these non-standard sources like cell phone towers, that's sort of creepy. You're tracking people around shopping centers and seeing how much foot traffic is going in and out of certain retailers, those types of things. But it's very valuable for a fundamental investment team to really have an edge over the competition. And so we do a lot of work in collecting, organizing, analyzing that data, and getting it in the hands of our fundamental teams. To augment their existing process, of course, which is centered around talking to companies and learning about their business models and so on. But
Of course, that's fantastic and sounds almost futuristic. So I wanted to get specific. Yeah, when you were on stage with us last at our Toronto Fidelity Vision event, you did share a couple of specific company examples of where this has helped our fundamental investment managers. I'm sure many come to mind. I'm curious if there's a story or two you could share with us today.
Sure. Yeah, I think last time I spent some time talking about using various flavors of transactional data and foot traffic data and whatnot. Another one that comes to mind though is one that is a couple years old, so it's not currently relevant for any portfolios, but just serves to sort of demonstrate the point that McDonald's, fast food chain, of course, they were going through, at least in the U.S., a pretty significant remodeling effort of many of their retail locations. And the idea was there to make the stores themselves more attractive and draw in more customers and convince them to spend more money and all that kind of thing. And so it was a huge investment. It was probably the biggest capex line item for a couple of years going on in their quarterly statements. And the question was, is they're going to get return on that? Is it really worth it? And so, and you didn't want to wait around for the next quarterly update from the CFO. And so what we were able to do was using geolocation data and a whole bunch of credit card transaction data and email receipts, foot traffic data. We were able to spin foot traffic data coming from cell phone data, right? Credit card receipts and whatnot, or debit card receipts as well. And figuring out two things. One, were the locations that had been renovated already, were they actually getting more foot traffic? And two, per person going in the door, were they spending more or less money than they were before, right? And this is data you get every day. So you get a daily update on this kind of stuff. And that kind of thing is a very powerful piece of information to put in the hands of the fundamental portfolio manager or the analyst covering the company, so they can use that to update their views on the efficacy of this big spend on the company and get an early a head start on the competition, understanding whether the return on investment is there or not. So that's one example that I think is very valuable.
Yes, that is a great example and story. Thank you for sharing, and a household name to many of us, I'm sure. So I did want to acknowledge, of course, this year it's been a very volatile market environment driven by inflation and many other factors, geopolitical intentions included as well. Curious when in the past Fidelity's quantitative team has been able to help guide us through times of heightened volatility like we're seeing this year.
Yeah, so one of the benefits of having access to all this data, so you can, like the example I just gave is getting a more granular, deeper dive understanding of exactly what's going on with the company's current. And another thing that one has to worry about, of course, when it comes to things like geopolitical risk, or let's call it policy risk in any given country, perhaps the US is the place to focus on today for that, with lots of uncertainty, it's yes, the prospects of individual companies matter, but also what can matter a lot is any one decision by a politician or by some other, some country, military or coup type thing in emerging markets. What happens is that creates like winners and losers in clusters of companies that have so when you have tariffs involved, right? There's clusters of companies that cross different sectors and operate in different countries that all of a sudden become basically the same trade, right? And they all go up or down together. And that's a risk factor, right? Because you may have exposure to one company thinking it's got the reason you own that company is for whatever growth growth rationale, but it's connected to a bunch of other companies, and that connection doesn't really matter until all of a sudden some policy changes, and all of a sudden it just goes down, even though the company itself is healthy, but it's connected in some way because of tariffs or its supply chain or something's affected. And so understanding how companies are clustered and linked together is a very valuable risk management tool. So one of the things we do with all the data we collect, in addition to providing deep dives on individual companies, we can build fairly elaborate maps of what's connected to what and in what circumstances things are likely to move together, so that you can monitor unintended bets in your portfolio. So are you, unintentionally doubled up on oil, or unintentionally doubled up or tripled up on the US dollar versus a basket of other currencies, or whatever the macro risk might be that is subject to the whims of geopolitics or policy and whatnot. And so we've invested a lot in what are called these knowledge graph databases that allow us to construct what's connected to what type stuff. I found this prior to me coming to Fidelity, actually, I found this approach very valuable during Brexit. It was 10 years ago, but all of a sudden, companies that were linked because of European trade, including companies that you wouldn't think of as being European companies. I remember the time Nissan Motor, which is obviously a Japanese company, became a big deal in Brexit. And we actually saw that in advance in the data I was using at the time, because we knew they were linked to European trade because they were building a massive plant in the UK that was going to export cars to Europe. Before Brexit, that made sense. After Brexit, it didn't, right? So you can see these connections, map these connections out, and that becomes really helpful information we can provide both to our fundamental team, but also use ultimately in risk models and in the systematic processes. So.
Mm-hmm. Thank you for sharing that example of Brexit, Neil. That's very informational and helpful for us to have. Clearly, your team, it sounds very complex what you're doing, to say the least. I mentioned earlier you have 200 professionals working with you. I believe that number is actually quite a bit higher when we look at the big picture of your team. I'm sure Fidelity's private ownership has helped you to build your team to the size and scale that it is today. Could you talk a little bit about your growth and recruitment process within your team?
Yeah, so I mean, I think to put that in context, that private ownership thing is really important, because everything I just described, right? That sounds, I'm telling the story, so I'm making it sound cool and interesting, but it is useful, but it's also very expensive, right? To buy all this data I'm talking about, it's not one or two data sets. You've got to have 30 or 40 data sets. And to find which 30 or 40 data sets are relevant, you have to evaluate 100 different data sets or so every year, in addition to everything else you're already using. And you have to build the technology and the tools and hire the data scientists and the developers to create the platforms that enable us not just to onboard the data, but to do analysis with it. And it goes on and on and on. I often liken it to building this whole thing. I liken it to a skyscraper where there's a giant pit in the ground, and you have to, for 2 years nothing's happening if you're walking by on the sidewalk, but what's going on is you're getting the plumbing, the electrical, the foundations, all that correct, and then up comes the skyscraper. And so we spent the first couple of years of my organization really focusing on that, and that's something a private firm can do because you can make the long-term investment. And the reason Fidelity is willing to make the long-term investment, and this was put directly to me by my ultimate boss, the owner of Fidelity herself, the goal is to make Fidelity as relevant to our customers and clients 10 years from now as we have been for the last 20. And it really is on these decade-long time horizons that you think about making these types of investments, so that all of our fundamental investors are armed with the best data, the best resources to continue doing what they've always done in a world that's changing and being evolved. You have to play in this tech game. You're still a fundamental investor in their case, but they need more data with different technology required to get it. So we want to be relevant there, but also once you invest in this technology, it opens up the ability to create new types of products and new types of solutions that either meet the evolving needs of our existing customers, or create the ability for us to work with and provide solutions to customers that may not have previously worked with Fidelity. So I think you have to think on like a decade or more long time horizon, and that's kind of the exclusive domain of private companies.
Mm-hmm. Thank you for sharing that, Neil. It is humbling, to say the least, to really feel the power of Fidelity being a privately run shop. So let's pivot our conversation to the investment side now, Neil. Last time you were on Fidelity Connects with Glenn Davidson, it was the day of the launch of 3 new Fidelity quantitative products. We've had a lot of interest in the Fidelity US Advanced Equity Fund and the Fidelity Absolute Income Fund. Why don't you tell us a little bit about those?
Yeah, so those are actually two really good examples of what I led with at the top of this discussion, talking about, our customers, they give us the size and the shape of the box they want a product in, and we put as much good stuff in that box as possible. So in the case of the Advanced U.S. Equity Fund, because of Fidelity's long history of being a fundamental active manager, we have, upwards of 150 fundamental analysts covering every sector in every country around the world, and a very, very large portion of publicly traded companies globally. And the idea was, how do we put together a product that the good stuff in this case is the best ideas from across all of our fundamental analysts, all in one place, such that we get a product that is getting our customers exposure to the best thinking across Fidelity's fundamental analyst population, but in a way that isn't subject to, it doesn't take on any of like the factor bets. So things like no exposure to growth, or no exposure to value relative to the benchmark, no small cap bias or large cap bias. And the idea, so just this pure expression of the best thinking across the entire complex. And the ideas get surfaced into this portfolio. We'll probably talk about an example in a second, but we're looking at everything from our analyst ratings on companies, but strong buy, strong sell type stuff, through to our analysts actually run their own little, we call them research coverage portfolios, that they're compensated on, and they're meant to be picking stocks with the coverage universe. And so we have access to, and we use the information from there. What do they have the most conviction, the least conviction in? Their models, so EPS estimates, price targets, growth estimates. And as those things are changing and evolving, and they write a new note after a company meeting, we're collecting all that information and taking it in the totality of it to represent literally the best current thinking of all of our analysts, but again, delivering it in a way that isn't taking on any of the sort of value growth exposures and that kind of thing. And so it's a risk-controlled approach to getting our best thinking, packaged up in an ETF in a cost-effective manner. So it's hopefully the best of all worlds.
Yes.
That's an exciting product. But then the other one, on the fixed income product, the Absolute Income Fund, that's another example with a different twist, where we've heard loud and clear from our customers that, well, yes, they want exposure to the U.S. fixed income market. They would very much like to get it in a way where the return a lot of the return comes from income. So the yield paid, the coupons paid by the bonds. And this is an interesting one, because portfolio managers in the fundamental space, they don't usually think of, am I getting my return from the coupon, or am I getting my return from price appreciation of the bonds, right? Because that all comes together to give you a total return. But our clients, because many of them are, want fixed income because of the income part of it, would have a strong preference for getting the return from the income piece. So what we're able to do is put together a portfolio that's benchmarked to the broad U.S. Bond market, but delivers approximately 90% of the yield of a high yield index, but the same other risk characteristics as just a more diversified bond index. And the way we can go about this is, it's basically an optimization problem, because most companies, while the companies only have one stock typically, they can easily have hundreds of bonds outstanding for large companies. And all those bonds have different yields, different coupons they're paying, and so on and so forth. And so while we can engineer the same credit exposure, right? Each company has basically the same, every bond from the same company has the same credit rating, or close to it. We can choose the bonds that have the higher yields. And so we can create a risk exposure that is, again, represent the broad U.S. bond market, but delivers a yield more commensurate with the high yield index. So this is a great value to our customers, and we do this via optimization. It's, again, not a problem that would be naturally or even easily solved by a traditional fundamental investor. but we do it with the quantitative techniques because we know that's what the clients are asking for. So that's a pretty exciting product that you kind of need a quant platform to deliver.
Yes, that does sound very exciting and very unique as well. So we will transition the conversation into fixed income shortly, but before we get there, I did want to
Mhm.
hold on the Fidelity Advanced US Equity Fund and ETF for a
Sure.
minute. We are disclosing holdings at the end of the month, but I'm sure our advisors are curious. I'm curious to know what you can tell us about how all of this quantitative strength we discussed earlier in the call has influenced the holdings within this mandate.
Yeah, so I think making it a bit more tangible for people is going to be really helpful. So the basic data we have access to, I alluded to a bit of it already, but like I said, is every time an analyst changes a rating or writes a new research note because they just met company management and they've got the change in sentiment around growth prospects, or they've actually changed the model, so they've updated their growth estimate itself, or got a new EPS forecast, or whatever it is. All that data is available. And if you think about the broad U.S. market, so think of like the S&P 500 or the Russell 1000, we get about 50, so 50, new pieces of information every day. Now, some of these are very small things, like a small change in a price target. Some of them are big things, like an analyst has taken a company that they didn't like before from a sell to a strong buy. So the importance of each data point isn't equal, but we get about 50 of them every day. And the idea is to harvest all these things and like I said before, create an exposure to the U.S. equity market. We're getting all the best ideas simultaneously trade off against each other. And so an example here would be, I'll give you two examples of how this works. So recently, and I know everyone's fixated on the Mag 7, so-called, these large, and they've had a rough go of it lately. But recently, all these companies, to some extent, have very similar. There's a reason they've all been doing so well, is because they're all very much attached in one way, shape, or form to the AI boom uh, that we've all been living through. But importantly, the way these different companies derive revenues, or the parts of the market that they have exposure to because of AI, is very different, right? Their business model might be different. You can have cloud providers versus the chip companies. They derive revenues differently. And so the way as the economy evolves, policy evolves, how companies are using AI in their business, how it's impacting the broad economy, the different ways these companies are participating in the broader AI space can matter. And so what we've done recently is our analysts internally, collectively, have started very clearly in their research notes after the most recent quarterly numbers started, you can see it, tilting away from a previous big overweight, one of the bigger beneficiaries. I can't name names right now because we haven't disclosed holdings yet, but these are Mag 7 type companies where we had a pretty big overweight to one of them. And it's a pretty quick rotation to a different one of the Mag 7 companies because of the changing prospects in the market and how not just policy, but how reports are coming through how businesses are using these. And so the most likely beneficiary is likely to be different companies. So this portfolio is rotated. And you see that coming through the notes and the analyst sentiment and all this across the whole complex. So that's how the portfolio can evolve from that on sort of within a group of companies. Another example would be a recently just new buy in the portfolio that wasn't there before, which would be based on an analyst that covers it. They went from having a neutral to negative rating, and all of a sudden you see across everything they've done, they've upgraded their model, they've got positive sentiment in the internal note they wrote, they upgraded their rating, the coverage portfolio they run, the research coverage portfolio they run, it's now one of their top holdings. So literally firing on all cylinders, bullish view on the stock. And so that got added to our portfolio as that analysts upgraded their view. So again, it's meant to be this real-time exposure to the best thinking, whether it's a new stock that's been found as a good idea or repositioning within a strategically important part of the market to benefit from the next 6 to 12 or 24 months of how the economy evolves. Those are two ways that we're actively rebalancing the portfolio based on all this data. But again, it's all driven by what our fundamental analysts are doing. And the intention here is to give our clients the real-time best thinking of all of our analysts.
Very fascinating. Thank you for sharing that, Neil. Before we jump back into fixed income briefly, we did have a question about the risk-adjusted returns process, how that's accounted for within quant, and also if there's a margin of error that's considered as well.
So risk-adjusted returns is actually, to a quant, that's the, I don't want to sound too judgmental. That's the right way to think about things. All right, are you getting adequately compensated for the risk you're taking. So what we're always doing is we're setting a risk band. So usually tracking error versus our index, 500 basis points of tracking error, say. And then the idea is to get as much expected excess return relative to that risk. Because if we're taking twice the if we're taking risk way in excess of the benchmark but only getting benchmark-like returns, we might not be underperforming per se, but we're taking an awful lot of risk to get something you could get in a passive ETF, right? So the idea is you want to scale up the amount of risk you're taking with the size of the opportunity set. And so so that's baked into a quant process because we use sophisticated optimization tools. And it's much easier, by the way, to forecast risk than it is to forecast returns. So we can be fairly confident in how much risk is in the portfolio. And then the error bars that were asked about, that's absolutely part of the process where we have these estimates for what we think the expected return is going to be, especially on a relative basis. Stock A will outperform stock B, will outperform stock C. And there's error bars around that, and that gets factored into the process, because if you just ask an optimizer or portfolio construction tool to say, give me the highest expected return with no uncertainty around it, it's just going to put all, the stupid thing will just put all the money in the highest expected return stock. But when you introduce uncertainty around those estimates, that's when these tools come to their fore and say, okay, well, I need to spread my bets out because not all of these views are going to be correct. Certainly not. And that's where we calibrate everything, and that's why we do rigorous back testing. And frankly, that's the most important part of back testing, is understanding how to calibrate how much risk you're taking versus the expected return that's in the portfolio. And that's something we put a huge amount of time into, in addition to managing things like transaction costs and liquidity and so on and so forth.
Well, thank you for that answer. I did want to ask you, back to the Fidelity Absolute Income Fund, how would you recommend that fits into a fixed income portfolio in today's current environment where fixed income is quite a timely topic?
Yeah, so the idea, like I said earlier the idea is we're trying to create a high yielding core bond portfolio. So again, the risk characteristics of a core allocation to bonds, but the income profile of a closer to a high yield index. So we're targeting 90% of the U.S. high yield credit index. But getting the credit duration profile of the broader index. And so thought of that way, what we're trying to deliver is the right level of risk for this to be a core holding. So sort of a central holding in your bond portfolio. If you're thinking 60-40, it can be the bulk of a 40% allocation to bonds, to US bonds at least. But it gets that higher income component. So it really is a core holding. It should be, I think of it as being something appropriate as a core holding for anybody who has a desire or a need to generate income from their bond portfolio.
Mm-hmm. Thank you for that, Neil. I think that's a great place to leave off our conversation today. I do recall the first time you and I met was at Fidelity's Boston head office last summer. I was in complete awe and mesmerized by the capabilities of you and your team. I feel as though today I've seen a little bit into the future of asset management, and I hope our viewers feel the same. I do want to remind all of our viewers as well to please check out the new product launch discussed today if you haven't already, as well as Fidelity's Factor ETF suite and all-in-one ETF suites that roll up into Neil's team as well. These are our top-selling Fidelity ETF solutions so far this year. So thank you very much, Neil, and congratulations again on the fund launch.
No, thank you for having me, and I certainly enjoy connecting with our customers any chance I get.
Fantastic.
Thanks for listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. On fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on X. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.